Hi everybody, Jim Crimmins here. It's Thursday, so we must have another class. Small Business Financials presents these each Thursday. Today is a real short one on how do I manage my balance sheet. One thing that I have found over the years is that most people don't know what a balance sheet is, how it's put together, or what it's used for. So we'll try to go through those today and give you a general idea on that. Obviously, first we have to do the government's work here. And our contact information if you need to call us. If you have any questions concerning this that don't get answered, you're sure welcome to call us at 623-33. My extension is 313. Or you can go on chat on our website and chat with me at any time about any subject. You may have set up your business some time ago, but let's take a couple of minutes and review some of the things that needed to be accomplished when you first set it up. Also, if you're contemplating setting up a business at this time, this gives you a good checklist as to what you need to accomplish. Financial records, the functions thereof, are to be utilized to raise capital. The most important one to me is so you know where you're going. So many people that I talk to that don't keep books, they are either using cash flow as an indication of whether they're profitable or not, and that's very dangerous, or they're winging it. We can use it to minimize the threats of fraud and internal and external losses. I think I've told the story before, but I'll tell it again. In an early life, I mean a way early life, I managed some jewelry stores in Las Vegas, Nevada. One of my best friends was a traveling salesman for a very high-end ladies line of clothing. And when he would get to Vegas, we'd get together. He lived in Texas, and one day he called me and said, "Hey, I've just been let go. I don't have a job. I need a job. Do you have anything for me?" So we were right downtown on Fremont Street there, actually right across from the Fremont Hotel. And I had been thinking about trying to stay open later than 9 o'clock because a lot of the revelers don't get started until after 9 o'clock. So I hired him to come out and run a shift from when we normally closed at 9 o'clock until whatever time in the morning was 8 hours. Well, we started doing pretty well, but I also had, for both of my stores and for all of the time, I had hired a shopping service to tell me how our people were doing, both as far as sales are concerned and as far as honesty is concerned. I got a call one morning, and they said, "Mr. Crimmins, we need to come see you." And I said, "Fine." Well, they came and told me that the fellow that I'd hired was running 2 cash registers, one for him and one for me. Well, when I asked him about it, he admitted to it. And of course that shut down that shift, put him out of work again. But that's one of the things you have to look at is internal theft in most businesses if you have any employees. Another function of financial management is to minimize the tax burden. If you do keep good financial records and you utilize them, you can lessen the amount of tax that you're going to owe at the end of the year by a great deal. In fact, you can come up with secondary and thirdary tax, I don't want to say shelters, but tax functions that will lower your taxes. Financial management's used to forecast the needs, the cash needs of your business, which is always important. And that's why we don't want to manage our business from a cash flow standpoint. We want to manage it from a profit and loss standpoint. But we need a separate schedule that is called a cash flow statement, which forecasts what we're going to need in the future so that we can make sure we have it. And then the last reason, or the last reason I've listed here, is when you get ready to sell your business, you need to have good financial records to show, first of all, the realtor that you're hiring to help you sell it, but then the person that is trying to buy it. So all of these are reasons that we need to keep good records. And we've gone through the P&L and other of those. Today we're at the balance sheet. Now the balance sheet is normally done at the end of an accounting period. It's a picture of what your business owns and what it owes at a given moment. It'll show you whether your financial position is strong or weak. Now again, I say 90% of the small business people I talk to don't use a balance sheet and don't understand what it's for. And it's really a simple tool. And your bookkeeper should be giving that to you at the end of each month. You can utilize this report to identify and analyze trends in the financial strength of your business and implement timely modifications to your business. Now, the format of the balance sheet, again, is very simple. It's assets, anything your business owns, liabilities, anything that it owes, and then it comes down to net worth. Assets minus liabilities equals net worth. The balance sheet should follow an accepted format and contain the following three categories so anyone reading it can readily interpret it. As can be seen, it is instantly apparent that if a business possesses more assets than it owes, its net worth will be positive. And conversely, if the business owes more money to creditors than it possesses in assets, the net worth is going to be negative. If you use accounting software for your business, it will generate a balance sheet for you. If you do your accounting manually, the figures come from your general records. And if you use a bookkeeping service, that service should be giving you a balance sheet at the end of each month. Start out with current assets. That's everything that is owned or owed, like accounts receivable, to your business that has cash value. Cash, petty cash, accounts receivable, inventory, short-term investments, prepaid expenses, long-term investments, and fixed assets. You want to be sure to get your fixed assets at the original value less the depreciation on here. Most of us have a lot more in fixed assets than we think we do as far as monetary is concerned. So you want to make sure that you have a good target on that. And as I've said before, when we start our business, we've probably before that been utilizing a desk and a computer and everything else. Now that we move over to the business, well, I hope you've sold it to your business at the fair market value on the day that you sold it, and then you can start depreciating it. Whether you take cash out of your business to pay for it or not is up to you. You can set up a long-term liability for the furniture and the computer and everything that you move into the business, car, whatever it is. Now, the liabilities are what your business owes. Accounts payable or obligations payable within one operating cycle, generally 30 days. Notes payable are short-term notes. You just list the balance of the principal due. Separately list the current portion of long-term debts. Interest payable, interest accrued on loans and credit to that date, not past that date, but just to that date. Taxes payable, obviously that goes without saying what it is. Any accrual for payroll, and what I mean here is most of us either pay every week or every 2 weeks. Well, the end of the month may come on a Wednesday and we pay on a Friday. So you have a certain amount of payroll that is owed as of that cutoff date. And so you need to put that in there. And then any long-term liabilities that money you borrowed from the bank or from somewhere else. And that would be, of course, less what you've already paid for it. Net worth, it's also many times called capital or owner's equity. For sole proprietorship or a partnership, each of the owner's original investment plus earnings after withdrawals minus any losses that you've had. In a C corporation, the sum of the contributions or the stock purchased by the owners plus earnings retained after paying any dividend minus any loss that you have occurred. So for different entities, which we're going to talk about next week, there's different ways of handling it. And that's the up and the down of a balance sheet. It's so simple, I am not sure why more people don't utilize it to compare last month to this month, see if you're doing good or bad or however you're doing, because your P&L may not tell you that. You may have sold a bunch of assets which didn't hit your P&L, and so your cash may have gone up, but it certainly wasn't due to sales or anything, and your balance sheet will show your cash, but then it will show a loss of those assets that you have sold. So it will tell you exactly where you stand. Now I'm excited with our next webinar, which is next Thursday. We're changing the time. We're going to try it at 7:30 a.m. because a little lady from the Glendale Chamber of Commerce came by and said that's the time that they have found that most small business people are available to listen to webinars. It will be 10th in our series, and what we're going to talk about is all the different formations, business formations that a small business could use. We're going to talk about sole proprietors, partnerships, LLCs, sub-S corporations, and C corporations. I really like to get into that, and I hope that you share my excitement on that. Now that'll be next Thursday, 7:30 a.m. Be sure and register. Let me see if we have any questions. You guys have been so quiet and reticent in all of the webinars that I've given. I don't see any questions. If you have any, you may want to go into the question box on your dashboard there and type a question, or use the chat button to ask me on the website, or give me a call. I appreciate your being here today. I know it was a short one. This is a short one. Thanks again. Hope to see you next week. Bye-bye.